Welcome back to the Algorithmic Advantage, everyone. Thanks for coming. It's the 13th of October 2023. Today we had the great pleasure of speaking with David Bush. It was great to speak with a mean reversion trader after all of our discussions with trend followers, so something different. We went through lessons in regimes. He uses an overlay risk management strategy, which was interesting. He even integrates some trend following principles for tail risk protection. And apart from that, there were some interesting tangents into music, David being a musician, how that helps with his trading. But today in the introduction, I want to keep it brief because I've got Rich with me, and now for something completely different. Rich, in the trend following space, we've got other news, I believe.
That's right, Simon. So we're launching the Aussie Turtles down here in Australia, which is an initiative of Adam Havriliv, who's from East Coast Capital Management, and myself. We both work together. And we're launching the Aussie Turtles down here in Australia with a bang. So on the 16th of November next month, we've got an evening with Jerry Parker, Moritz Siebert, Moritz Hayden, and Adam Havriliv. So we've had the two quants, Moritz Siebert and Moritz Hayden, on the podcast. Jerry we're having in December, and also Adam in December. But the four of those guys will be down on the 16th of November in Sydney at the Bebo Wine Bar between the hours of 6 p.m. to 8:30 p.m, where we will be having canapes and drinks and having a panel discussion where Jerry and the two Moritzes and Adam, and it will be hosted by myself, will present the turtle story and the classic trend following methodology to the participants of that event. And it'll run for about 45 minutes. And then after that, we'll all be mingling with the guests and answering their questions and just having a great night with some great canapes and some great drinks. Cocktails. It's a free event. That's right. But look, there are limited seats available. There's about 50 or 60 seats. So we're calling for expressions of interest effectively by registering at our website. I'll just give you the name of the website. It's aussieturtles.au. So AUSSIETURTLES.au. When they click on that, they'll see a bit about who the Aussie Turtles are and what we're about. And then if they click on the event itself, then they get further details about Jerry, the two Moritzes, and Adam, and about the story of the turtle story, and they can register their expression of interest there. And we hope it to be a great night, certainly a trend-following night, which is a bit different to the podcast today, which is with a mean reverter, Simon.
Yep, but many ways to skin the cat, many notes on the keyboard, as we talked about, because we got into music. So it's a great show, but that night's going to be really good, Rich. I can't wait. I mean, it's just going to be such a pleasure to have Jerry and the M&Ms there. So it's going to be a really
and
good
you're
show.
Going to be down there too, Simon, which is going to be great.
I'm lucky. So let's just get into today's show.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
We generally launch straight into it, David, so
let's do it.
It's good to start with a background, obviously, and an understanding of how you got interested in trading and in the markets. I'm particularly interested in how you got into quantitative trading. So can you give us a high-level summary of your journey to date?
Sure. There's a big gap between how I got interested in trading and quantitative trading. I won't fill up the gap for the next hour.
Well, you can give us a high level.
I'm going to give it.
Yeah,
I will absolutely do that. So I remember, this is very specific, but I don't know why I remember being at my father's home. I'm in my 20s. I'm a full-time musician. That's my whole life was music up to that point. And I think he had on CNBC. The ticker fascinated me. I mean, I spent my whole growing up studying music as a drummer. I play other things now, but also I remember watching this ticker and just knowing there was opportunity in that. I did okay as a musician in terms of, of a living, but it wasn't killing it. And so I just remember being fascinated with the ticker and thinking, I really wish I knew more about that. And I also remember that somebody made some comment, I don't remember who, about how valuation can change overnight. In other words, what is valuation when the market can be at X price, on a Tuesday night or on a Friday night, let's say, and on Monday morning, it could be 20% lower, obviously, speaking of the stock market and in a dramatic, scenario. And that idea of what is the psychological component, the ticker streaming, I was just mentally hooked. I didn't know anything, but I was determined to get into it, right? So that started that journey. I can fill in a lot of spaces in between. I used to get briefly used to get a fax service. This is before the internet, so I'm, obviously speaking to my age right here.
Some of us know what fax machines are. Yeah.
Yes. So I used to get these fax sheets, and I subscribed to one. I called them up after I'd been, following it for a little bit. And I never could purely follow it. It's in my nature just not to be a follower somehow. But I took inspiration from it. I saw that they had a plan every day, et cetera, right? So that part of it, I followed the results. Like the commentary, that was the best part. Anyways, I looked them up, called them, and said, hey, I'm a subscriber. Can I meet you? Right. So anyways, I was living in Woodstock, New York at the time. I had formerly lived in New York City. I went back towards the city. They were in White Plains. Anyways, long story short, I studied with them, offered me a job eventually. And so that was a retail, very, very small retail trading floor in the late 90s. So you can imagine, the kind of environment that was with the .com boom underway. So I was a discretionary trader at that time. That was obviously very early in my career. So progressing, not linearly, but very quickly, learning a lot all the time. And, right into the bear market that followed. So long story short, I traded discretionarily for many years. However, I always wanted to know, and then I got, good. It took a while, but I got to where I could be consistent, where I was very confident. I could trade concentrated size, and, and I had the discipline.
What kind of systems were you trading when you were discretionary, David?
I was trading, no systems. I was trading on, general principles. But general principles. So I'm trading all technically always. I'm fascinated in, macroeconomic stuff now and valuation to a degree. But, back then it was purely technical and just on principles, price principles. You can imagine I could go through the list, but pattern recognition, I think that ties in with my musical background, just to go on that for a minute, because as a drummer, that's what I was doing constantly. Sure, I'm learning music, I'm learning to interact with music, but essentially, it's all pattern recognition. It's separating parts of, my limbs from each other, that independence that you learn as a drummer, especially when you get into, jazz and so forth. So the reason I mention that is simply the patterns. I think, I don't know, but I think some part of all of that process for years, hours a day, factored into my love of charts. As soon as I started, that journey of, after being at my father's house and starting to get into the market, as soon as I found charts, I said, oh, what is this? Now this, this I can understand some part of just by, some
You could see
intuition.
a waveform there, and
Yes.
yeah,
I can see peaks, troughs. I can see congestion. I might not know any of these terms yet, but yeah. So you can imagine that's where I really got hooked. And at any rate, so the point where I said, I need to code. I'd long wanted to code, but it was when I just realized I never knew what was optimal. So let's say a trade is going well. I've bought some kind of retracement, some stock or another, maybe it's a futures market, doesn't matter. And it's going well. Well, when to exit, I mean, there's all sorts of, in kind of the trading education space, and there's all sorts of kind of rote things that people say that when you code and you test them, some come out being true, others are debunked because the stats just aren't there for these adages, but it was really the exit scenario where I'm like, okay, this is going well. Sure, I'd love this to, move to a new swing high, to make a 90-day high, new yearly high, whatever it is, right? But no idea whether that's going to happen. That's really what I wanted to solve above and beyond anything. So I can, kind of go on from there, but that's where I said I need to learn how to code, because obviously I'm not going to be able to model anything if I can't.
Did you find some software to help you with that in those early days, or did you start building your own software?
No, I did not have that skill. So Mechanica, I think it used to be called Trading Recipes, but Mechanica, I don't know if that is even supported anymore, no idea, but that is what I use. And in a way, while I don't do a lot in Python, I do some things. In a way, when I looked at Python notebooks and so forth, I saw that it's very similar to Mechanica, like this just columnar, rows and columns kind of format. And you're just writing out the calculation for every indicator, and you can see it. And anyways, not to go into Mechanica, but that is how I started. And I modeled many systems. Then immediately I said, well, one system. I mean, I just philosophically, I just can't get behind one approach. What if it breaks? So I started to think, well, I need to have many systems together. I need a portfolio of systems. Then you immediately run into the obstacle of, well, how do you track your capital? I mean, you can't just run multiple systems that have infinite capital, and, all the systems, let's say, are finding equal opportunity or a lot of opportunity on a given day or week or whatever it is. You got to have a methodology of rejection. So therefore, you have to have a hierarchy of systems. At least this is, were my conclusions. Others might conclude otherwise. But so, I put these systems in a hierarchy. I explored different hierarchies. I started to reject, had a methodology to stay within the capital, stay within certain exposures, sector limits, all these other things that, the deeper I got, the more I wanted to employ, while all the time trying to keep it simple. So the core logic of every system, I try to keep it as simple as possible. I'm an Occam's razor kind of guy, I think, in a lot of ways, definitely in terms of my strategies. But just, I think, in life, I generally like simpler things, simpler experiences, quite frankly, rather than super ornate, complex stuff. So even though I'm also fascinated in that, I tend to choose the simpler logic, the simpler ways of things, I guess.
Fascinating. And so what sort of year was this when you were getting into quantitative trading, would you say?
Yeah, that was 2009. And, I think part of the reason was 2008, I'm a discretionary trader. I did okay, but it was hellishly exhausting. It was incredibly exhausting, even as somebody who, I have pretty good control over my emotion, I think, as a trader. And yet it was just so taxing. At the ends of those days, I would just feel flattened. from the volatility. And, I embrace volatility, but nevertheless exhausted. I think that really, I'm kind of forgetting that. But as I talk about it, that was a factor in pushing me into finally going, all right, let me code, because, this active decision making is very mentally taxing, especially in this kind of environment. So that was one of the pieces that pushed me over.
So you worked out as well that with quantitative trading, you could obviously save a certain amount of time. You didn't necessarily have to direct all of your energy to watching the screen.
Exactly. And I don't know whether the phrase the decade of data was in vogue yet. I think that might have started in 2010, 2011. But just the idea of, I've got all this computing power and I'm sitting here manually poking through charts. And while I like that still, I do that in the crypto world a bit, but that just seems so foolish. Like, why am I not taking advantage of like this CPU, GPU power, whatever, to make my life simpler? It just didn't seem logical to let all this computing power go to waste. So that principle too bothered me and pushed me into learning to code. Obviously, I had a lot of resistance to learning that, because I just had a block. Like, well, that's for coders. I'm not going to be able to do that. But that wasn't true. It's a very logical and rational process. So once you get over that headache of what is the syntax, why does nothing work? I think I have this statement correct, but it still won't verify or validate or whatever. Once you get over those headaches initially, then I was off to the races, because it was completely engrossing. It's a total rabbit hole.
And Dave, just quickly with the systematic processes,
yeah.
Do you view it now as how systematic are you? Is there a discretionary front end in your idea generation, design, all of that sort of stuff? What level are you? What you'd regard as systematic?
Yeah, I would say, pardon me, I would say 95 to 98%, and here are the discretionary elements. So everything is hard-coded. I've got multiple systems. The risk control is hard-coded. Everything is systematic, except I will have some discretion over the model when it comes to execution. So what I'm talking about is not whether to take the trade or not, but am I going to TWAP it? Am I going to VWAP it? I will use a little bit of discretion because that is not something in my model. And that is, I've looked into solving that and making that purely systematic as well. But for a variety of reasons have chose not to. So that is a very small part where the idea is going to get executed as per the model. It's just going to get executed maybe over the first hour rather than at the open and so on, right? And then the only other element of discretion is occasional discretionary hedging, which I have now made systematic in the strategy. So in the earlier part of my track record, which goes back from March 2011, anytime I hedged, I was using my discretionary abilities and hedging off tail risk. But that now I've incorporated into the strategy. So those are the discretionary elements. Otherwise, I'm systematic, quantitative.
Thanks.
I've heard you say as well, David, early on when you were getting inspired about quantitative trading, that you were reading books and you read about the turtles, for example. So that also formed part of your inspiration?
Yes, I'm fascinated by trend followers. I'm not one, at least in my systematic work. Discretionarily, I've done trend following, but again, that's not the level of trend following, let's say, that Rich, I believe you do. I'm fascinated by the turtles, by the whole experiment, by the philosophy of trend following. And I was thinking about it before we started in the last couple of days. We scheduled this a week ago or so ago. And I'm not a maximalist like some people are. And again, forgive the crypto reference, but in the crypto world, there are maximalists, right? There are Bitcoin maximalists, there are Ethereum maximalists, there are Solana maximalists, and so on. I think in the TradFi or quantitative world too, that you've got the same kind of divisions, at least to some degree, where trend followers repudiate mean reversion. Mean reversion say it's superior to trend following, so on and so forth. And I'm just not one of those. I've got one trend following element in my otherwise mean reversion strategy, and if I can take a piece from wherever and incorporate it, philosophical nugget is what I'm alluding to, from the turtles or from, an entirely different field, quite frankly, not even finance, and bring it into my strategy, at least as a guiding concept, I'm into it.
Yeah.
So in your early days then, before we do get into what you do today, as you were getting into systematic trading and you started testing and building strategies, like what did that first few steps look like? Did you get some ideas from somewhere and say, well, I'm going to try, did you fall on mean reversion quite early on in the piece? How did you start to formulate those first few strategies?
It's a great question. I think that I first, if I remember correctly, I first started with simple retracements. So I think I started with, kind of an uptrending context defined in one way or another, and then looked to define the retracement. I probably started very specific with price-based logic, and then realized that was... my logic was too narrow, and I expanded. Okay, well, how are other ways I can define this event, this retracement within this context? Does slope matter? Does the degree of, some moving average matter? Does the slope number matter? I started with that idea, and I immediately saw that that it was working sometimes, and other stocks not working. And I don't think I realized this right away, but I eventually gravitated towards really institutionally sponsored stocks. Like the mega cap equities have stronger reversion properties, at least with my logic, than, let's say, the bottom of the Russell 2000, for example. So, and skipping perhaps a little bit of ahead, that's how I started. But once I had built out all these systems and figured out a way to combine them and the right software to do it and so on, which has evolved over the years. But what I realized was, okay, I think I've got a great model here, and I've kept the data out of sample throughout the process. I knew to do that, but I said, well, where are the blowups? Like, I looked at the current constituents in my model, and there's no Enron, there's no WorldCom, like the symbols, the stocks, the companies that live in infamy, for their astounding blowups. They weren't in the model, So that immediately I said, oh, well, that's illogical. I mean, I've gone through this whole year to 2 years of work. I think it had probably been about a year and a half at that point. I think I'm in 2010 at this point. And I said, well, crap, I got to build a survivorship bias-free data set. So that was a real pain in the ass, because I did it to the day. I know there are some available products, data sets, and so on that you can buy now, so you don't have to go through the headache. But I was researching all of these companies. What is the S&P in all of these years, or the NDX and the OEX is what I trade, the individual constituents there. And, getting, the exact inclusion and exclusion dates. In some cases, it was impossible, but I did it, I don't know, probably to, around 90% accurate, maybe more. And then I pressed run essentially on everything again over this whole new data set, not knowing what was going to happen. It was my whole year and a half of work about to go up in this horrible ball of flames, or was I going to, survive this, so to speak. So drawdown was a little worse. Compound annual return was a little lower. But otherwise, the logic held, and I was obviously thrilled. And
Well done, Dave. That would have been a relief. That would have been a relief.
Yeah. I don't think we'd be talking right now if that had just combusted. But so at that point it was, all right, well, now I need to do like Monte Carlo analysis. I need to look at the sizing so I can determine drawdown as, one of my guiding metrics. I know there are, obviously a lot of metrics you can use as your objective function, but that was one where I said, all right, early on, let me see what I can tolerate. What can I tolerate? So all the logic stayed the same. All the risk controls stayed the same. All of those hard-coded elements the same, but let me now run this strategy through its paces in terms of position sizing, because I have to be able to always pull the trigger. I mean, I traded long enough to know that people get themselves into trouble even with positive expectation systems, right? You can have a positive edge and through sizing just completely blow up, which is both the ignorance and naivete and maybe arrogance of newer traders and sometimes established traders who just lose all discipline, I suppose. But so anyways, that's kind of the very Simon, the very early part of when I first tested right up to right before I was going to go live. I realized I really can't go live. I've got to include the blow-ups, and Lehman's got to be in there, Enron's got to be in there, etc.
Did you so you started with equities and you just stayed there, or have you had some forays into futures or options or tried other things?
I've traded all of that, and yet systematically I've stayed completely within equities.
And what is it that you like about trading equities?
I think, first of all, it's where I started. So it's where I feel that I have the greatest domain expertise, the greatest knowledge, even a feel for, which maybe I shouldn't say in a quantitative podcast. I remember speaking to a, let's say, an institutional interest, right? An institutional guy, very sharp, former, might have been former Millennium. Anyways, and he was speaking to me about my work, and I said the word feel in some context, and he noticeably bristled, as if you can't have a feel, a non-mathematical feel for a market. You can't feel the emotion. So I'm completely digressing. You're going to have to remember what you remind me what you even asked me. But
well, we're talking about equities, but I like the point.
Well, I don't think I realized until I was in this for a while trading, and maybe even after I'd quantified stuff. But as I really thought about, people have, rightly said, listen, music to finance, like what happened? Because I have a lot of musician friends who play with people you would know, like very big acts and so forth. And, and sometimes they're like, what happened to you? And, I don't get how you shifted from one to the other, but and it is a strange left turn. But on the other hand, like, it's all emotion and rhythm. That is what really the guiding thread from my early days to right now is. It's all patterns, it's all cycles, it's all waves. It's emotion and rhythm. The music is especially all music, but jazz context, like the dynamics are constantly shifting. So you've
got to be listening to music as you're doing your back testing, Dave. I mean,
I rarely do, because I can't stand the extra input mentally. I don't often do that while I work. Sometimes the market opens and I put on whatever I'm in the mood for, just to give me an extra, step in my seat, if you will. Mm-hmm. But I think that that emotional component and understanding markets from that perspective, that, think of human beings, like the world right now, not to talk about these awful events happening, right? But human beings are capable of the most beneficent, amazing, acts and emotions and completely selfless behavior. And they're also capable of the exact opposite. So when I mentally, I think the standard deviation of human nature is is massive, right? So I always try to, that's just my belief system, right? That's part of my philosophy. So that I always try to bring that into any discussion, any new market I'm trading, and any, in terms of my systematic work, any discussion of risk that, or any problem of risk or anything I'm trying to tackle on the risk front is knowing that, Black Friday, there'll probably be a worse Black Friday at some point. 1987 seems like a long time ago, but, I know people, maybe you guys do too, who, on the floor, whether it's the SIBO in my case or somewhere else. But at any rate, I've digressed, I'm sure.
No, but before we get on, Simon, I just want to mention that I tend to visualize things. I have a clear link between music and trading because the way I visualize things in the markets is like a sound engineer. These return streams I see as waveforms and how you compile return streams together. And, the idea being it's sort of like an orchestration of different return streams, putting them together when you're doing system diversification and all of these things, how you get the best uncorrelated mix, when you put them together. So it's funny. I see this very strong link between musicians and trading. And, I know there are some traders like Adam Grimes and people who are deep into their music and things. So I can see this natural sort of link between the two. Is that how you see it as well?
Yes, it's nice to hear that you see things that way. I totally get your image for sure, and I think I completely agree with that. Yeah.
Well, I was just going to say a similar thing in that it's a similar part of the brain involved in mathematics as in music, right? And music is very mathematical, extremely mathematical. Yes. So it's probably no surprise, and I love the way you dovetail that into the emotive or non-quantitative side of what we do, even as quantitative traders, because as I've said before, there's a whole suite of non-quantitative decisions going into being a quantitative trader. To me, there's no argument against that. You're deciding what markets to trade and what systems to trade and what data you'll use. I mean, you're making all of these decisions. So,
yes.
And then you've got a very limited amount of data, really. It's not like we're observing nature and have billions and billions of data points over, say, hundreds of years. We really backtest over relatively short timeframes. So I actually like the idea that there's some intuition that's still involved in this process to think probabilistically in the right way. So, agreed.
Agreed, yeah. It's well said.
Awesome. All right, Rich, if you didn't have anything else, maybe we start to move into then how you're trading today, David, where this has all come to for you today. And I'd love to just slowly unpick a bit about mean reversion and the strategies that you trade, and we'll progress through the risk side of diversification and so on. But yeah, so what are you trading today, and what does that look like, and what are some of the main philosophical foundations of your trading strategy?
Sure. So as far as what I'm trading, what the strategy is doing, it is trading a mega cap universe. So as I might have said earlier, OEX constituents, NDX constituents. I've brought in that in a couple systems because, again, I have a meta system that's comprised of several independent systems. But basically, they're all trading either that specific portfolio, which is a very narrow portfolio of roughly a couple hundred stocks, to maybe up to about 350, but ranked by market cap. So it's always the top of the market cap chain, U.S. domestic equities.
Is that because you're looking at liquidity, Dave? It's essential to have liquidity in what you do?
Rich, I think it was because when I first started testing my ideas, which were all coming from years of discretionary trading, what I found was, especially the reversionary ideas I was testing, worked better, again, at least with my logic, on the mega cap equities, which, it has remained the case right up to this current day. I've certainly looked to expand and with the same logic to lower cap stocks. And, I could, if I liked those compound annual return to draw down profiles, I just wouldn't trade them. So I leave it alone. And so we're trading mega caps, and then the strategy obviously divides between, well, maybe I haven't said it yet. It's a long short equity strategy, right? So obviously there are long systems, there are short systems, and then there's a third category, which I call vol cap, which is just volatility capture systems. And
can you explain that, Dave, a bit for our listeners?
Right. So the long and the short systems entirely mean reversion. The vol cap is essentially trend following. So, if you are mean reversion, you are always short volatility, not, literally in sense of you're shorting a volatility ETF or ETN or something like that. I don't mean that. But, you're always short volatility in that, a trend follower is trying to capitalize on, a sudden vol event, upside, downside, whatever. And that's the bread and butter. That's what the constant poking and jabbing, at least in my language, of a trend follower is doing, right? You're just constantly looking for the vol events, and hopefully multiple vol events. That's exactly what you don't want as a mean reversion trader, typically. I mean, there's a sweet spot where, the volatility can help a mean reversion strategy, but if there's a true breakdown, or crash or what have you, or just regime change, the sudden volatility can be the enemy of several mean reversion strategies. So
that's effectively your tail risk protection on your overall portfolio. That third trend following strategy.
Yes, that volatility capture bucket has, there are two components to the strategy. The vol cap is the offense in terms of volatility. So in other words, when there is acceleration in the VIX, then the vol cap strategy essentially will kick in, right? And the strategy will be buying a volatility ETF or ETN. And sometimes layering it in, adding to it systematically, but adding to it if that acceleration continues. Because as we know, sometimes there could be a VIX spike, it gets faded. In fact, people famously, had systems they thought were great. I always hated them, where they're always fading volatility and thinking they were printing money. But at any rate, those are bound to break. But there is that volatility capture as offense. So that, helps the mean reversion systems that are now getting escape velocity. They're not reverting. It's a buffer. It's like a counterpoint to that, right? So the other element of or approach to volatility in the strategy is, I think of it as defense, which is based on certain top-down. The strategy is a lot of bottom-up factors, which I haven't discussed yet, but there's a top-down element where the strategy will look at relevant indices, OEX or QQQ SPY, OEX, SPX, whatever it is. And it's on a per-system basis, but they look top-down and define certain conditions where the mean reversion doesn't work anymore. So, for example, when I found, in my logic anyways, when the market is a certain, like X% stretched, if you will, above various, averages, my logic just delivers less. Like the expectation didn't hold up. So that was something I looked at after the strategy had been running for a while. And, these certain kind of elevated... So
your top-down's your regime filter, effectively.
Yes, exactly.
Using market externals, that sort of stuff.
Right, looking kind of top-down, regime filter in a sense. There's individual regime filters in the systems, but I'll leave that for a moment. this is the kind of a global regime look, right? Yep. And so the long exposure will shut off based on a few different factors that are built into the strategy. So there are certain conditions where the strategy refuses to be long anymore. Maybe they're short, maybe it's cash. That's not super common, but it does happen on occasion. So those are the kind of the two elements of using volatility, which again sometimes can be helpful to the mean reversion systems, other times can be very harmful. So this is a way to take the tail elements and build it into the strategy logic from this top-down approach. And maybe more than you want to know, but the individual systems will review all of the equities in my universe and go bottom up, looking on a per ticker basis, and determine what the quote-unquote regime of that particular name is, that particular stock, and whether that should even be included for consideration as a position. So there are a lot of filters that happen from from A to Z, I guess, when I run the data and determine the next day's positions.
So these filters all work as a combination where your overall regime's being detected, and then your stocks are being selected through your bottom-up approach, etc. So the ultimate sort of combination of this is a particular characteristic regime that you want to be trading that particular stock in.
Yes, I think that's correct. The way I would phrase it is the bottom-up process looks at each name in the universe and determines whether it is still fit. Is it quote unquote, to be real simplistic about it, is it technically healthy or technically distressed? And either eliminates it from consideration or says, oh, it's technically distressed. I have a system called distress, for example. It's technically distressed. Well, now we have a different set of logic. It's in the same system, but a different set of logic based on this context that it's much more difficult to trigger entry, right? So technically healthy environments, nice. In 2017, you're more liberally, the systems are more allowed to more liberally buy, according to all the logic, et cetera. But in a fall of 2011 or a fall of the fourth quarter of 2018 or whatever it is, much more stringent, either excluded, not even considered as a long possibility, or there's a different set of entry requirements that have a positive mathematical expectation in a distress scenario that is completely different set of probabilities. So that's all the bottom.
I like that. Interesting.
Yeah. That, and I don't know how I came to that, obviously modeling and testing, but probably some bit of intuition that, the distribution is just completely different in a very, in one environment versus another, and that not to go off on some other tangent, but that idea fascinates me. How computers, and I'm not an expert in this, but how computers can calculate, very exponential fractal calculations, and then the computers blow up and calculate differently. The same computer can calculate the same thing differently because it can't handle the exponential load of it, I guess. And then just nature, how some things are built to withstand. Built to withstand the hurricanes. Again, I love the tropics. Maybe we talked about that pre-interview, but, I just love, how you design things for distress, right? I have a favorite architect, and, his buildings through Maria and Irma in 2017, unscathed. There was one latch he had to redesign in his future designs that got stressed. Everything else, completely fine, no glass in his buildings, lots of other things. So I just find anything about, take inspiration a lot from nature, and the idea of regime change is fascinating to me. When do things revert? When do they get escape velocity and they just break? All of that I just find endlessly fascinating. I think that to me is more fascinating than, like I don't listen to the financial news a lot. And again, it's a bit of a tangent, but I take my inspiration from that more than I do from analysts or I don't know, whatever the common hot stock narratives are, whatever.
So it sounds like a lot of that research that you did do was centered around looking at worst case events, and that directed you. What stress test results revealed, so to speak, like looking back over the past and looking at the worst things that could go wrong, the things that could really go wrong, was probably more influential than looking at the things that went right, which is even in the backtesting arena, so to speak.
I think that's exactly right. And that is my nature, for better or worse. There's some ways that really comes in handy in finance, and especially in finance. Certain ways in life it probably doesn't help so much, you know. But yeah, it is my nature to think of like what is the worst thing that could possibly happen, and how am I not going to get screwed by this and lose a ton of dough?
I can sympathise with that. I think the same way. I think when we trade mean reversion, that's a big part of it.
Yes.
Okay, and with the long short, so obviously the market regimes can vary, but otherwise in an average market, is that generally a 50-50 split between the long and the short, or are you slightly long biased, or?
I would say it's long biased, definitely not a set portfolio construction. So exposures change. The strategy can be net short, although there are limits. There's an outer limit on the degree of net short. The volatility, I do count. Let's say the vol cap systems are long, and I'm long a VIXI or formerly VXX or whatever it is. That counts towards the short exposure as well. So it's a variable portfolio construction, which is very, as far as I understand it with quants, pretty non-standard. You know, there are a lot of, you know, strategies that I've read about or interviews I've listened to or whatever it is, where there's a set portfolio construction. It's always maintaining this gross exposure. It's, you know, never exceeding certain net exposure, and there you go. Total respect for different approaches, but my approach is I guess, more organic in the sense that it's dependent on how much opportunity the logic is seeing, so to speak.
So, Dave, your controls that you're applying from the top down, bottom up, etc., that's on a per strategy basis, or are you also looking at global controls across your three strategies?
It's actually on a strategy level. So there are position sizing constraints. That's the sizing component. There are sector limits. Really, industry group limits is a better term. So, you know, the strategy won't fill up with, you know, every biotech stock, for instance, in my universe, which is probably a limited number, but at any rate, so there are controls that way. And those are pretty global. So it's not on a per system basis. It's okay. We've processed all of the system logic. Now it's time to look at the hierarchy of systems and make sure that no capital constraints get violated, make sure that no industry group limits get violated, and factors like that. That's kind of the latter part of the processing of the data and the code. And then everything gets sized systematically and is ready for me to, you know, to upload, deploy, whatever.
Yep.
So you've talked, David, about having multiple sub-strategies. Can you just go into that a little bit? Like, to what extent are your, I guess, meta strategies broken up into sub-components? Have I heard you right say in the past that there are lots of individual models running under these sub-strategies?
Yes. So the way I think of it are, you know, there's the strategy, that is the meta system, right? That is everything, right? And then there are the individual discrete systems. And one assumption would be that I have all these systems and I have made them all, uncorrelated or largely uncorrelated, but that's actually not the case. They very much overlap, but they are unique, right? So the systems derive their alpha. Every system has to have a unique positive expectation, of course, and different technical factors drive them. So there's some proprietary, formulas. There's different differentials of momentum. Divergence is a part of one or two systems. So all technical factors, not uncorrelated. There's correlation between them, which is probably, again, not typical. I don't know if that answers your question, Simon.
So there's quite a few sub-strategies or quite a few discrete systems?
It's
talking about?
I think it's currently, it's in the neighborhood of 10 currently. So it's not, we're not talking about scores, 30, 40 competing, systems. But in essence, they do compete for capital and in a specific hierarchy so that, if there's an overwhelming...
What's your preference in terms of diversification? A trend follower would say, well, their aim is to diversify across markets as many as they can get their hands on. But someone in your area would say, well, diversification across system is very important. How do you feel about diversification? Do you feel that system diversification is the way to go, market diversification? You're talking about how some of your systems are fairly correlated. Obviously, that's something you want because most people say, well, that they're after uncorrelated properties. So can you explain those things to our audience?
Sure. I guess stepping back for a moment, I have a good deal of capital in my systems. I have a couple versions of what I've been describing to you. One that has no short, it has inverse ETF instead of the short component. It trades a bit fewer positions. Max number of positions is a little lower, in other words. So I have a couple of versions, but basically it's all the same drivers. It's all the same logic driving these two versions of the strategies. I have significant capital in those systems, but personally, I have other buckets where I have capital deployed as well. So I don't look for that diversification inside of what I've created in the equity market. That is my equity approach. So I totally get, though, why a trend follower wants to, trade these various different types of, of markets that are uncorrelated and look for the trends, of course. But in this case, I'm not looking for this to be my one and only approach to growing money, growing wealth. So I don't know if that answers your question, but
no, that's fine. That's fine.
So if let's just say, so if someone were looking at my strategy, going, oh, well, I'd like to be part of that strategy. Really, it would be foolhardy for their whole egg to be in my strategy. It just, does it serve a purpose in their portfolio would be a better question. What slice, what sleeve, etc. is how I would answer that.
So you offer a unique return stream for your particular strategy, which inevitably should be part of a wider portfolio in terms of how much we allocate towards it, etc.
That's how
as opposed to a standalone.
Exactly. That's how I think of it. Right.
Okay.
And of course, you've still had a great track record, even if someone was invested, not that they should, but be solely invested in you. I mean, I believe you've had a strong track record. So you're obviously managing your risks quite well. And talking about those different sub-discrete models that you were talking about, I know with my mean reversion trading, that's part of that risk management component to I guess, in a sense, not be all in and all out of stocks at the same time, for example, so that we are controlling and managing our exposure and position sizing. So, along those submodels, would it be correct to assume that as much as they're correlated, they might have different entry conditions or different exit conditions? Is that the kind of thing we're talking about?
That's exactly correct, yes. Yeah, they're capturing different sides of the diamond is somehow how I just mentally think about it, right? There are a lot of ways to look at various technical conditions. I'm looking at short-term, maybe I really haven't discussed this, I'm looking at short-term opportunities. In fact, this year has been very challenging. And as I've done my own analytics on my strategy, which I visualize, take the data and I just visualize it. And, I've noticed that the reversion time for several of the systems is longer. Like the days in trade is longer this year than it has been. Like the reversionary property in my universe, at least according to my logic, is not across the board, which is good, but in, I'd have to look over here to my left, but in a number of systems, it's been longer. So at any rate, back to your question, the systems look at different sides of the diamond, like different technical setups, and kind of tying it in with the last point of this is not trying to be diversified across all markets. I'm trying to be the best, financial architecture that I've created. I'm trying to just maintain that. I am not trying to be an all-weather, strategy. From a risk perspective, I do try to shoot for that. The first losing year I've had in all of these years was 2022, down the enhanced strategy, which uses occasional leverage, down a little bit over 5%. So that was disappointing to finally have a losing year. But at any rate, I knew it was bound to come at some point. Again,
Dave, we came off a decade of poor performance as trend followers, and suddenly in 2022 we're doing well in 2023. So it's funny how the game pivots from you to us, Yeah.
Right. Well, it needs. I'm trying to pivot it back from you, Rich. So don't.
We wanted to keep going.
Yeah. Don't get too comfortable over there. Yeah,
indeed. So let's stay on this because this is absolutely
Sure.
one of my questions, David, as a mean reversion trader. 2022 was tough. It was different. Still coming into 2023, I know mean reversion traders are struggling. So all of those MR traders who are listening will be thankful that I ask these questions. But what have you seen in your analysis that has changed in the markets over this period that's led to that performance? And is there something that's standing out in your research, even if you haven't got a conclusion to it yet, but things that you've noticed? You've mentioned the reversion periods are longer, and I think you can look visually at a chart too and see that the stretches in the market quite elongated. Is there anything else that you've discovered over the 2022-2023 period?
Yeah, it's a great question. I found this year to be more challenging than last, at least from my strategy perspective. Sure, I was down slightly last year, but the market structure seems to be changing. I don't have all of the answers as to, I couldn't write a good white paper right now on market structure in 2023. But from my strategy perspective, I feel like I've got some good insights. Not that you need specific numbers, but I've done a deep dive on my strategy over the past few months, and the average days in trade across all systems has been trending higher since for all years of my strategy. So reversion, at least with my logic, is getting slightly longer. So like I've got a trend line. Maybe I'll show you this chart after we speak, and you can use it as you like. But it's a high right now. 2020 was the quickest reversion time in my logic at 6.482 days in trade across all trades. Right now I'm at 9.86. So and usually it's right around that 8 number. So it doesn't seem like a big deal, but when I'm looking across all trades and just that reversion taking longer, that's more time in trades in my system anyways, and maybe this is applicable to other mean reversion traders, but more time in trades tends not to be good. The quicker reversions are the best reversions in my logic, which is stopless. I don't trade any concentrated positions in, unlike my discretionary days where I did trade concentrated size. I currently, the system trades smaller positions, nothing concentrated, and that's part of the risk, umbrella philosophy, etc. But at any rate, that time and trade has been growing, and that is interesting to me, and I'm still doing further research on that. There's other things I could discuss, but that is noteworthy to me.
Well, 6 to 9 days. It's a 50% increase, so it is significant.
And 6 days is the shortest it's ever been in 2020. So probably the average. It's a good observation you make. The average, in fact, I'll tell you exactly the average is because now I want to know 8.457. Right, is the average through the years. So we are clearly above that now. Not dramatically, but yeah, on a percentage basis, it's not insignificant still.
With that concentration risk, so let's talk a bit about risk management if we could.
Yeah.
So I trade a lot more stocks than you. So being concentrated in the OEX and NDX, which you've said, so the NASDAQ top 100 and the S&P top 100, you're trading a fairly small universe of those mega caps. Does that make it hard to keep your concentration risk down?
No, I haven't had that experience. It's a good question, but I found that there's enough opportunity, certainly in a more strongly uptrending environment, especially. But there's always opportunity between the two versions of my strategies, between inverse positions, between the long positions, short positions, and the volatility capture. There's a lot of levers to pull on, if you will. And so, no, there's never been any issue with I need to size these up because, I'm only currently at a 25% net exposure position. I wish I was at 100. The logic is telling me that there's less opportunity right now, and I don't want to be fully deployed, for example. So that is just a feature of the strategy, which it is adjusting. The beta adjusts, and that's in a way part of the risk management. If in one scenario, the bottom up process has determined that the universe my universe has been reduced dramatically because my logic is saying, we're now in a technically distressed environment. I don't want a lot of exposure unless it's the short exposure, the volatility exposure, and the select long exposure that maybe is trading under a new set of logic, under the distressed entry conditions, while other systems just kind of go offline, so to speak, for the time being. So that's all part of the risk management, which I certainly can speak more to.
Yeah, give us your high level then of stepping back, risk management for mean reversion in general. Like, what are some of the overriding principles you think? Like, what are the key things to consider, especially when we think of what Rich would tell us, which is, of course, that and we know this mean reversion strategies are subject to that negative skew and that fat tail risk. So from that high level perspective, what are your, risk controls What's the philosophy around guarding against the typical mean reversion risks?
I would start, and this is not necessarily in order, but I would start with the philosophical ones, which is, it came up earlier, like Occam's razor. I mean, if you are making your logic so complicated that you're essentially, when you're modeling, probably overfitting, and you're probably just creating this beautiful backward path that winds and wends its way through the past, like avoiding this cliff, and then you hop right, and you avoided that quicksand, and that's what you're creating, right? So you have to have, especially I think as a mean reversion trader, you've got to have logic that generalizes. So therefore, it, at least in my opinion, it has to have has to be able to move easily through these environments. And so that's one element. And really quick on that note, and forgive me for quoting Robert Frost, but this sticks from my English class in high school, great teacher. I remember this Robert Frost quote, which I think I'm going to get close to right, which is, poetry is moving easy in harness, right? So in other words, you have to have risk controls, you have to have these constraints. Other elements are, sector limits, no concentrated positions, identify the regime. I'll talk to that more in a minute because that's hugely important. But you've got to be able to, the logic has to move easy in harness, right? It's got to be able to walk into the future and take whatever comes at it and navigate it. Sometimes it's going to do poorly for periods. Sometimes it's going to do exceedingly well. But overall, just avoid the overfitting. Make sure your logic can navigate and generalize, and then avoid the overconcentration. I would say, so the simplicity is kind of like the overarching theme, as well as these avoiding concentration elements, at least in my approach. I would say regime is the other huge thing. Identify the regime however you can, right? I mean, the regime, you can define that 1,000 different ways, I'm sure. I do it my way, and in a couple different ways. I do it from a bottom-up way. It's embedded into each system. I do it from a top-down way, which looks at global factors, and both are important, I've found. So have to have some, as a reversion trader, you have to have some way or ways that you are looking to, you're looking for that fat tail on the horizon. And at least when it arrives, you are adjusting to it. So I guess both elements really are part of my strategy's approach to risk management.
Dave, how do you deal with chaotic regimes? So in other words, let's assume that we've got a couple of, maybe three different regimes. We've got the predictable regime, which we can exploit with the edge that we're extracting from it. We've got our regime filter that can identify a change in regimes. But what happens when we flip almost at an instant from a predictable regime to a chaotic regime? You don't have stops in place in your models.
Right.
You've got your regime filter. How do you stop that negative skew event?
That's the easier scenario in my experience. Not that it's easy. I'm not saying it's easy. It's easier than the slow bleed into a new regime, which I'll get to. But the switch from we're doing fine to it's the fourth quarter. I mean, I think maybe 2018 was a bit like this. But whatever the time period, when the lever just kind of flips and the market just kind of like gaps down and just starts running south, my model adjusts to that more easily. So existing long positions, they're probably going to get hurt. They're probably going to revert ultimately with losses, or at least some of them are going to revert with losses. However, my volatility capture is probably kicking in. That is acting as a buffer, and sometimes a differential will bring me ahead after a few days of suffering. Obviously, depends on the specifics, but that has certainly happened where the deeper now the retracement goes in the market, Now I'm flipping to where the volatility element of my strategy is overwhelming the existing long systems.
I see.
And so it's
So your long vol's giving you protection there for the sustained protracted downward move, the big flip, the big regime change. What about the the rapid move down, the rapid move up? Are they nasty for you? Is there sort of what regimes? I suppose it's not explicitly long vol; it's more trend following style of protection with those major moves down or whatever, but it's not like an option strategy that gives you immediate protection when you get the short, sharp reversion, is it?
No, it's not. It's not. Back to the quick flip, 2020, March 2020, our best month ever, because the model, our strategy stopped buying, at least most systems stopped long exposure in later February, if I'm not mistaken. And then our volatility kicked in with the start of the pandemic and delivered us, between all of that, delivered us our best month. So that's obviously a very, strange and extreme example. In terms of what you just said, Rich, which is the, more, now volatility is elevated, but we're swinging back and forth. I kind of recall May of 2020 being like that, although I might be mistaken. I'd have to kind of go look back at my data as well as the market averages. But that was another good month for us. That was kind of, at least in my view, my recollection is that month was kind of what you described. Where my strategy is the most flat-footed is when there's just kind of a slow bleed, and it's not necessarily dramatic, although it starts to get the percentage decline of, let's say, the S&P or what have you, starts to get noticeable, and there's just no reversion. The market is just stepping down. Put a short moving average on there, 5-day, 10-day moving average. It's never coming close to the average. There's just no reversion happening. But there's also no volatility acceleration. The VIX is just languishing, or it's elevated a little bit, but there's no charge or impulsivity in that. That's the toughest environment for my strategy.
But it's not going to kill you. It's just going to give you a bit of a building drawdown, a bit of a slow bleed.
That's right. It is a good point. It doesn't. It's not going to decapitate me. It's just going to just annoy me and give me a headache. Yeah. And have me prodding the data, which I do regularly, to see how is my model doing, because you always want to look for edge decay. When is it broken? When is a system no longer effective? My system's generalized well, but I've had to take some offline permanently, not just as part of the changing exposure of the logic, but
what's the decision there, Dave? When is there a threshold you have where you say, I'll turn that system off, or what do you do there in relation to identifying a system that you don't want to deal with anymore?
Don't want to deal with anymore. Very, very good way to put it. I don't have one single objective function or metric that I go, okay, well, it's, the Sharpe of this has fallen, or the MAR has fallen to, below this threshold or whatever. It's not one element. But it's usually a combination of maybe those things I just mentioned. So it's a matter, it's not an exact process. I wish I had a better answer for you. But the process for me of determining that is looking, visualizing all the data, right? So not just looking at spreadsheets, not looking at code, but taking all the output of my strategy. So my strategy dumps a lot of stuff into flat files in a lot of different ways. And then I take that and I use a data visualization program to look at it all and create my own dashboards where I can compare basically any metric to any metric, whatever it is. And that is... fun. I find that really fun. Other people, again, I don't know if you guys have had this experience. Somebody's talking to you, or they look at your computer and they go, "What do you do?" And you're like, "Oh, I'm looking at these charts." They're like, "Oh my God," and they just walk away. But that kind of stuff is fun. So I just unlocking the data, visualizing it, and seeing the ways where maybe there's deterioration across a few different metrics, and obviously the returns of that strategy are not there anymore. I will pause it until I understand it better, or just remove it. And I haven't had to do that very often. Happily, I'm not a tinkerer. I don't constantly parameterize. I don't know if that's a word. My strategies, but I do examine them, and when it gets to the point where there's a system that is just not delivering, then I'll take it out of the strategy. And it's funny because sometimes I will look at the equity curve of that system alone and I'll go, that's a nice looking chart. It used to be just a beautiful uptrend. Now it's a symmetrical triangle. But in a strategy, you don't want a symmetrical triangle across 2 or 3 years where it's basing and its logic is going to be great again in 4 years from now, because it's just going to be a drag on the strategy. You're going to be using this capital is going to get stuck inside the system that's basing, if you will, like a great pattern that a discretionary trader might trade. But it's got to be taken offline because it's just going to be a drag on my strategy. I don't know if I articulated that.
Do you keep monitoring those ones you take offline? Do you keep monitoring them just to know when to turn them back on again if you need to?
They run every day. They're not now part of the strategy, but they're all in my technology. They're all in my, they get run every night, I guess is what I'm saying. So they're just not included in the strategy. So I can keep tabs on them that way. I don't look at them nightly or daily, to that level, but it's very easy for me to just go, hey, let me see how
gone but not forgotten.
Gone but not forgotten. Thank you. Yes, precisely.
Just a highly related question, and don't feel like you have to repeat all of that, but just the evolution of your strategies then over time, which is related. Like, have they changed much? Have there been some key points of evolution of the thinking?
Yeah, it's a great question. Definitely, I would say not a ton of changes, just generally. The logic that drives the systems, it's the same as from day one. What has changed? More risk controls. The top-down process didn't exist at the beginning of my track record. So in other words, defining scenarios in the market where my logic just actually doesn't really perform, when the market is elevated by this definition or the opposite perhaps, and going, why am I allowing it to trade when I can see in this context suddenly there's like very little expectation. So those things were newer, maybe they're 5 years old, something like that. I'd have to look at my document, but so logic the same, risk controls enhanced, top down newish, half the track record or maybe a little less, but I've maybe foolishly, but I've kind of prided myself in not being a tinkerer and constantly optimizing and so forth. But but I'm also fascinated in genetic algorithmic strategies. I don't know if you guys have messed around with that kind of stuff or traded.
I've been down that path. Yeah.
Okay. Yeah. Well, when I started podcasts, I'll have to have you guys on to ask you about that. But I find that fascinating too. No a priori idea at all. Here's a ton of conditions. Here's a ton of data. Go to town and evolve genetically. That's fascinating too. And obviously, I would imagine that if there's edge decay there, you just re-optimize all over again. And maybe you do that every week. I don't know. I'd have to speak to those kind of traders. But I'm kind of the opposite.
Dave, do you use any non-price data in your regimes, or any data from outside of the markets or outside of the instruments that your traded instruments, like looking at cross markets or non-price data?
Right. I look at that in my market analysis and a research letter that I write, I look at some of that. I don't, in my strategy for equities, I don't. So the Stratversify strategy, which is what we've been talking about here, that is purely price data. I'm trying to think if there's any volume component anywhere in there, but essentially it's price data driven. There's no fundamental factors. There's no sentiment factors. It's very much what it is. I have my little niche. I have the probabilities over a pretty short window of time, as we've kind of discussed with the days in trade, and that's what I just want to excel at and also protect in terms of from a risk perspective, exploit those technical factors to exploit them the best I can while making sure to protect against the escape velocity and so forth factors, and regime change and all those other things that can be like a hurricane, come across the logic.
Is there any particular software or data that you use now that you're happy to talk about? Maybe even in thinking about newer traders. And what they could use for backtesting or for data for survivorship, bias-free data, and so on. Yeah,
certainly. So if I were starting again, I would look at newer. I would look at learning a generalized language. Like I have learned these trading specific languages. I started with Mechanica. I've learned trading blocks. I've been interested in IME Broker, but I haven't done much there. TradeStation, I know how to code there. PineScript, I do a lot in now, and that is TradingView, as you probably know, TradingView's platform. So I have a great fun with PineScript currently around the crypto universe. But if I'm a new trader, I would learn Python, or at least use software that maybe has a lot of keywords and things built to make your life easier, so you're not building everything from the ground up, but uses Python and sucks in the pandas library and all of that stuff that Wes McKinney has built and others have built, and all of this data that is there for you, rather than being siloed in one of these trading specific platforms. So
you're not reinventing the wheel. You're using sort of all of these modules that have been fully tested, easy to do.
Exactly. So I would probably start there, or use a more modern trading specific platform that can incorporate some of that. A lot of those are very expensive, but if possible, I would start there. As long as I had confidence that company was going to be around, right? Because you just don't want to build this beautiful mousetrap and then have it all disappear. So in terms of what the things I've used, I mean, I mentioned some of them. Trading blocks, I've built a lot in. I'm very happy with what I can do in trading blocks. It's very powerful. I don't think it's keeping up. Maybe I'm wrong about this. I don't know whether it's really keeping up with the times. So that's, again, where a Python and so forth would be valuable. Norgate data, and Simon, you mentioned survivorship, bias-free data. Norgate is, I haven't used that data, but I've heard a lot of people praise that data. Now, you're probably talking only end-of-day data, so if you want intraday data, that's also survivorship, bias-free. There's probably places to go for that, but I don't have them at the top of my head.
Yeah, so I'm a user of Norgate and speak very highly of it. We'll chat with Richard from Norgate on the podcast, because he's got a lot to share about just how that data comes together. It's a really fascinating topic in itself, really, having clean data to backtest on. And,
yes.
And recently have also been using RealTest, a backtesting engine, which is a simplified language backtesting tool, but just incredibly fast and incredibly simple. So it's great for research and development.
I'll check that out.
Play together quite well. So just we got to start wrapping up, and I want to talk about crypto, because I know you're doing some stuff in crypto now, which is interesting. But just in terms of your back testing and building these strategies, then are there any particular metrics that you like to look at when you're testing strategies, whether it's a Sharpe or a Sortino or a MAR, or what are your objective functions?
I have a formula that is a combination of a lot of what you just mentioned: Sortino, MAR, profit factor. Those are very important to me. Profit factor is useless unless you have a ton of trades, right? So you can have if you have 30 trades in some system because it's not very active, whatever it is, that profit factor number, if it's very high, it's a little bit easier to achieve. If you have thousands of trades in your model and still have a high profit factor, that's more meaningful to me. So there's never one metric that describes all of the aspects of the strategy. I'm on I chair an investment committee right now that is looking at other equity strategies. And as I discuss with these other guys on the committee, these various strategies, it's just remarkable how many ways you can slice performance and how many ways you can how no metric ever describes it all is the simplest way to put it. So I know that's not anything new, but I try to look at my favorites and I combine them in a proprietary formula that I just give a score to. I've never named it. I think it's just DB score in my work, and so no one single objective function, but kind of a combination of some of those that you mentioned and I just mentioned. And Monte Carlo analysis, I mentioned it before. That's very important to me, to run thousands of iterations on the model and determine a confidence level. You don't want to just, if you're a new trader building a model, let's say you've been working at it for a while, you've got a model, you press run or whatever, execute, model executes, you get an output. It's got all the metrics, right? And it's got a compound annual return. It's got a worst drawdown figure on a daily level. It's got everything else. That's a single run. You want to look at alternative histories, right? So you want to just churn all that data. You don't want to burn the data, but this is just the end step where you want to, or at least I want to, see all the other histories, all the other ways that this could have worked out, and then have a confidence, interval. So, 95% confidence over, 5,000 iterations that the worst drawdown will not exceed X. That kind of thing is very important to me. Again, if you're going to be risking, one's capital is and the importance of one's capital is going to differ from individual to individual, of course. But, if you're risking anything of size, whatever size means to you, then you really want to put your strategy through all the paces, every possible ring of fire you can possibly conceive, and make sure that it's passing through all of them. Maybe not unscathed, but within the parameters, within the box that's tolerable to you and that you can continue to trade. So probably more than you asked, but yeah.
Dave, on the backtesting, you've talked about the Monte Carlo, etc. Do you also split into in-sample, out-of-sample components, and do you do things like walk forward optimization, that sort of stuff with your strategy?
Yes, at least I would say, again, with a new trader in mind, at least do the reserve data, right? That you never touch, and develop it over the in-sample, of course, and then and then test over the out-of-sample. Walk forward, more sophisticated, but very important. So you sum of the future leaks into the periods typically of the walk forward, but that's certainly a great way to do. You're minimizing some of the overfit by doing that.
And do you pay more attention to more recent data, or do you treat all of the data over the backtest as essential in your philosophy and development?
Yeah, it's a good question. I tested when I was first developing it. I try to think. I probably had about 15 years that I looked at. Which, to Simon's earlier point, and maybe you too, Rich. We're often looking at these tiny slices of history, and yet the data can be very difficult, or at least it used to be, less so now. Very difficult to obtain all the data, for so many reasons. There's the data sets aren't there, or they're exorbitantly expensive, or they're private, or they don't even exist. So, in terms of what you're asking, Rich, I think you were asking, is the do you
pay more emphasis on your recent or sort of all of your data?
Yeah, I have to admit, as I look at the strategy, at retesting things, with the consideration of possible changes to the strategy, I am reserving more recent data and only testing up to a certain point. So it never sees, maybe a difficult period that I want to test over that is reserved for out of sample. So I tend to do it that way. I'm not sure what the best practice these days is considered to be, but I will put aside the more recent data. I tend to make the out of sample period larger than a lot of people recommend. If you look at, and I don't use this, it's not part of my strategy, but I've played with them, so to speak, the genetic algorithm strategies. They tend to maybe, look at, use, I don't know, maybe 80% in sample, 20% out of sample. I might be a little bit off there. It depends on the program you're looking at. But I tend to want a bigger out of sample period to test over. So it's a balancing act.
Okay.
It depends what the frequency of your, are you dealing with 50 trades in your model, or you're dealing with 5,000? I'm more the 5,000 person because I'm working in the short term window. And so there's a lot of data to consider, which gives me more confidence in terms of statistical significance. Is there really an edge here? And a bunch of other ways that helps me. But if there's less signals, I think that'll be more challenging.
It's interesting, Dave. You and I come from almost philosophically different ends of the spectrum as far as our approach. But see, something I totally appreciate is that there's an edge to be had in lots of different aspects of market behaviour.
Yes.
And I recognise there is definitely an edge in what you're doing. And I'd say there's an edge in what I'm doing as well. But a lot of people view that as me assuming that it's a one-size-fits-all mentality, where I don't agree with that at all. And that you almost have to have because you've got a counterintuitive philosophy in these different areas, you almost have to have a counterintuitive process on different ends of the spectrum as well. So, when we're talking about, in-sample, out-of-sample data, sort of that's anathema to me, because I use all of the data because of my particular process demands that. And yet, when we talk about what is best practice, I'd say, well, there really is no best practice, because these different philosophies have totally different approaches, and you've got to think in terms of what is the best practice in their approach. That's the way I'm viewing it. So I totally understand where you're coming from, and whilst a lot of people that might be interested in what I do or whatever might not necessarily see your approach, I do totally understand where you're coming from.
They're gonna be very angry at Rich after this interview.
No.
There are minor chords, there are major chords. Sometimes
we're going to come out of this with a symphony. We're going to have a symphony at the end of this.
No, that is right. And briefly, I know we're wrapping up, but briefly, a trader said to me in so many words, like really a long time ago, and I was kind of new, something to the effect of, it's just risk management. It really doesn't matter your logic. I've not all the time, but I have at one period used a random entry generator as part of my testing process. So now my entries are being completely thrown out the window essentially, and it's choosing a different part of the data, maybe in the bar or in the week or whatever it was that I was testing, and it really becomes now about your risk management and your exit methodology. So that. I think there's so many ways to approach almost anything in life, definitely in finance. Again, I'm anti-maximalist. I don't believe there's one way.
Yeah. The only difference I'd say is that you enjoy Pachelbel canon and the rhythmic, tunes of Pachelbel's canon, where I might be going for Prodigy when I'm getting into my big trends,
Yeah.
That works.
Yeah, I like more than Pachelbel, Ockeghem, Johannes Ockeghem, but we won't go down this path.
Okay.
Yeah. Late medieval, brilliant music.
All right.
It's right in between polyphony and homophony, where everything, now our ears just hear major and minor. Everything always resolves to that. We can't even hear music outside of that regime. It's just a regime. And Ockeghem is right in between, where it was all polyphony, where all these separate lines, kind of like, your alpha streams in your earlier image, Rich, different waves and so forth. All these different voices. I said I wouldn't go into this. Sorry, I am. But all these different voices.
No, go into it.
All these different voices interweaving and creating chords, but it's not within the major minor homophonic regime that Bach really entrenched with equal tempo.
Does it sound discordant? Does it marry together well?
It's beautiful. It does not sound discordant, but it's surprising is what it is. With modern ears, you listen to Johannes Ockeghem, Missa Me, or his Requiem, and so things seem to resolve, but it's not. It then floats into a different direction. And it's because these different voices are coming together in this moment that seems like a resolution, but it moves elsewhere. And so there are resolutions, and it does come back to the tonic of the resting place. But anyways, I didn't mean to get into all that. But yeah, Pachelbel, pretty straightforward. Johannes Ockeghem, fascinating, especially with modern ears, because of the interweaving of things. And see, that's one of those things, that's what I want my strategy to do. Occasionally come together, be more correlated, other times be less correlated, some systems more active, other systems taking a break. It's kind of like just getting inspiration from all these different parts of life,
Uniquely positioned,
Yeah.
Even to the ears.
Yeah, exactly, right, yeah.
That's great. Hey, David, we better talk about crypto, because I know you got into crypto.
Yeah.
I've told you in the past that I spent a bit of time in crypto until I got burned in Luna. And then I saw FTX blow up as well, and the ensuing bear markets. But I was, until those points, getting more excited. And so I did spend a bit of time, but not enough. I am fascinated by blockchain technology and what can be built on Ethereum and where we could go with that. But tell us about what got you into crypto and what you're doing in that space now. Yeah,
sure. I'd love to. What I'm doing, just to answer that first, is writing a Substack. So it's Rectelligence Report, REKT, so Rectelligence. And basically, I am quantifying crypto market setups, primarily Bitcoin, Ether. I'll eventually expand out. There's really not a lot of data, of course, because, January 3rd, 2009, that's Bitcoin, the first peer-to-peer distributed crypto, finally goes live. We don't even have really data, of course, back to that time. The best data starts 2011 to now. So again, it's a very limited data set. But I just find, without going a deep dive into that, I just find that asset class absolutely fascinating, because you are now incorporating these network effects into the asset, and the decentralized nature of it is fascinating. The fact that it is an asset, any of these, that if you possess the private keys, you literally... I don't do this, but you literally could hold the asset in your mind, and you can walk cross-border with it, right? So there are all these, well-known stories, or at least some of them are well-known, of, people in very distressed countries with hyperinflation, whatever the case may be, Argentina, Venezuela, and so on, where, they formerly, could never transport a bag of gold if they were fortunate enough to have such a thing. across borders, they're going to be robbed, it's going to be stolen. Now that you can walk across a border with the asset solely in your mind, literally for the first time in history. I find that's just one of the the many things about this asset class I find interesting. And unfortunately, I was on a panel a long time ago with fortunately I was on this panel with the first hedge fund manager of a Bitcoin fund, Dan Moorhead. And I was so busy at that time with my own equity work that I just didn't check out. He added me to his list, and so I was getting his newsletters. And this asset, I'd get the report, and it would be like, and Bitcoin is down 78% for the year. And I looked at this, I'm like, what is this? Like, if I had more time, I would look into it, but I was too busy. Didn't really look into it. I mean, that was 2014. So, a little bit more curiosity. I might have done quite well, but I got into it later in 2017, and once I had read the early history and Satoshi's white paper and so on, I was pretty floored with the potential. So, anyways, that's what I'm doing in that space. I'm just analyzing. I do some essays. I do some price analysis. Whether it's Ether Bitcoin ratio or Ether Bitcoin or again, in the future, some other assets. I'm looking at probabilities, what's next based on this technical set of conditions. Pretty simple.
So not mean reversion, not trend following specifically.
And not even a strategy, looking at an analysis. Yeah. So, when, it's obviously fun to look at periods of great distress and go, all right, for Bitcoin, greatest history or the most history, what does this imply? How many times have we seen this setup before? Of course, you can define the setup multiple different ways. Sometimes I'll do that. Sometimes I'll visualize the hypothetical trades. What if you had, when these three conditions had occurred every time, 2011 to the present, what's next for the asset over 7 days, 15 days, 30, 60, 90, and beyond out to a year. So I just have fun visualizing these very new assets, and in my opinion, totally revolutionary. And then there's a lot of crap in that universe too, that is never going to amount to anything other than noise, and maybe rug pulls for some unfortunate, unsuspecting, naive traders or investors. But the best of that space is phenomenal, in my opinion. It's also a space where, briefly, it's very welcoming, at least in my experience, very welcoming. Doesn't matter. No one is from crypto in a sense. Everyone's from somewhere else, and so at least my interactions with people in the space are very welcoming and encouraging. And I have not always found that in the traditional TradFi world. There's a lot of pomp and arrogance, as well as there's you guys who are awesome and engaging, right? So it's a very mixed bag. Crypto, I'm sure it's also a mixed bag, but in terms of welcoming people who to the space, it's like, hey, well, what are you contributing? Come on in. I do like that attitude. So that's kind of my interest in a nutshell.
All right. Well, we'll provide links to all of that. So I guess we should just wrap up, David, unless you've got anything, Rich or David, and just remind me, but we'll end with giving people your contact details. But is there anything else from you guys?
I'm exhausted of all of my questions, Dave. Well done.
No, it's a real pleasure to speak to both of you. Hope to do it again sometime down the road, and I thank you for the conversation.
Thanks, David. Yeah, well, speaking of down the track, actually, that last thing that you just mentioned where you did that test on your data with random entries. I mean,
yes.
We could do a whole show on that. That does sound good. So, yeah, we'll have to chat again.
Certainly.
So, yeah, thanks very much. We really appreciated it. And it was great. I got to talk mean reversion with a fellow mean reversion trader. And
he had a buddy.
Yeah.
Well, it's good. We got to stick together. I would love to do it again. Certainly, that'd be fantastic. And thanks for staying on me. I've been nose down in a couple other projects, and you had to hound me a bit to get
we
timely
know you're busy.
responses. So I appreciate you doing that and making it happen.
Yeah, awesome. All right, so where should we direct people, David, if they do want to get in contact with you?
Sure. I would say if they want to get in contact with me, my email, I'll give that to you, davidbush@alphatative.com. My new crypto research, if anyone's interested in that, that is rectelligence.xyz, or the Substack is really the place to go, which is rectelligence.substack, or is it substack.rectelligence? I can't remember now. At any rate, find me on Substack easily.
Are you on Twitter?
I'm on Twitter as @Alphatative or @rectelligence. Yes.
All right, great. All right, well, thanks once again. I think we'll wrap it up.
Guys, thank you so much. Appreciate it.
We should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives, so nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.